All right, thank you again, everyone. We're here to discuss the 2024 tax policy outlook with a panel of our esteemed guests here at Crux, and we'll be starting in just a moment. My name is Katie Bays. I'll be moderating today's discussion. Folks who have questions are welcome to ask them at any point in the conversation by entering the question into the Q&A feature. You can do so anonymously or not, and we'll do our very, very best to address all of those questions. We have a lot of material that we hope to discuss today related to important issues of tax policy and politics in 2024, both domestically and internationally. I'm going to begin by introducing our panelists. And I'll start by directing some structured questions to our guests. Everyone who on our panel who wishes to respond, you're very welcome to do so. We're likely to disagree, I think, today. There's a lot of speculative and questions around how the world is likely to evolve. But our primary focus here is to try to understand the outlook for tax policy and especially how it pertains to the implementation of the Inflation Reduction Act and the use of clean energy tax credits to finance the energy transition. So I will start with our friend Mary Duffy. We're delighted to have Mary Duffy with us from Andersen. Mary is a managing director and head of Andersen's U.S. national tax practice. She advises clients on tax policy, legislative and regulatory changes, accounting methods, and accounting issues arising in transactions, amongst other topics. We have our friend Itai Grinberg with us today. He joins us from Georgetown Law. From January 2021 until early 2023, Itai was the Deputy Assistant Secretary for Multilateral Negotiations in the Office of Tax Policy in the United States Department of the Treasury. He was the lead U.S. negotiator for the global corporate minimum tax endorsed by the leaders of the G20 at the Rome Summit meeting in 2021. So we're very grateful to have Itai's perspective. From Capitol Counsel, we're pleased to host David Bridges, a partner in the firm's DC office. On Capitol Hill, David served as a senior staff negotiator for members of the Senate Republican leadership, the Senate Finance Committee, and the House Ways and Means Committee. Prior to his tenure on Capitol Hill, he worked in government relations for the energy and manufacturing industries and on issues of energy tax. And then from Jones Day, we have Jonathan Gould. Jonathan provides bank and financial, regulatory, and strategic advice to financial services providers of all types. He's here to save us all from having to talk outside of turn around Basel III. So we're very grateful to have Jonathan with us. And then last but not least, of course, we have Crux CEO Alfred Johnson. Alfred has experience in a wide range of financial and tax policy items through his time working in Washington and at BlackRock. We are also gaining a lot of exposure in our work at Crux to the issues of tax policy and how those policies shape the formation of the market for clean energy tax credits. So we have a lot of perspectives and a lot of topics that we hope to address today. To kind of start us off, Mary, one of the reasons we conceived of this discussion in the first place was that the number of tax policy items that are in front of Congress this year, surprisingly many, and that is certainly influencing the way many companies think about their tax strategy for 2024. So I thought we could begin the conversation by tackling some of those near-term domestic policy items. Can you give us just a general overview of the state of tax policy before Congress and kind of the outlook in the near term for federal tax policy changes?
Sure thing, Katie. And I think as we had discussed during our prep call, this webcast is very timely as with respect to that question. Back in January, there was a bipartisan tax deal that was unveiled and that passed the House at the end of January. Kind of for businesses, I assume most folks here are businesses. The highlight of the items was to claw back or further extend the research cost capitalization provision only with respect to domestic research. It would have what we call bring back the depreciation and amortization into the add back of the Section 163J interest expense limitation. And it also would have extended a bonus depreciation. I think that package had a lot of momentum and a lot of excitement And then it went over to the Senate and it kind of hit a snag. And a snag wasn't necessarily unexpected, because I think we always felt like the package needed a vehicle, which could have been the appropriations legislation. We saw that second set of appropriations legislation unveiled this morning, expecting that to move forward over the weekend. But it, of course, did not include the tax package. What we understand happened was that there were some policy disagreements, mainly coming from the Senate Republican side. Since there were policy disagreements, didn't make the appropriations package. Had everyone agreed, it could have very likely moved forward. I think the policy issues were, as I understand, around the child tax credit provision, which is probably not as interesting to the folks on the webcast, and there may have been some other concerns around retroactivity. So where does that leave us? I think, the coffin is almost closed on the tax package. There's an outside chance that there'll be another last-ditch effort to bring it back in the short legislative period after the Easter recess. So, but I think there's a very strong consensus that if it doesn't make it over the finish line by April 15th, it's just dead. And so I think at this point, can maybe not nail in that last nail, but it's not looking good. And I think people can plan on the status quo when you're thinking about your 2023 and 2024 tax situation. A few things to think about with respect to these provisions. Is there a chance this will come back in the lame duck session, or could we see this move in the future? Well, with respect to the research position, you're kind of reaching a steady state, right? It was 5-year amortization. It's really painful as you're building your base of amortization, but we're kind of getting to that point where, okay, it's not so painful anymore as it was. So I think it'll be hard to resuscitate that item, or it may just kind of wither. With respect to foreign research, it was really interesting that this tax package, and I think it was for revenue reasons, changed to allow expensing for domestic research, but not for foreign research. The current capitalization and 15-year amortization would have been retained for foreign research. So query, that looks like that's probably going to be a permanent policy difference, even if we get to change for domestic research. And then, the 163J and the bonus, 163J is so painful for so many of our clients now with the low base and interest rates being so high, but it's hard to see how that's going to come back. So I think we can nail that final nail April 15th, and at least we have some certainty on how to proceed for the rest of the year. And I think the longer term tax outlook, what's going to happen with the TCJA expiring provisions, beyond the ones we talked about, that just really remains to be seen depending on the results of the election.
Yeah, I mean, David, I also kind of want to put you on the spot in terms of if you, from your perspective, are you and your clients still actively hoping for, looking for anything here? What are y'all thinking from the Capitol Counsel point of view?
Thank you. Yeah, it's kind of interesting with respect to the current tax bill. Obviously, hit a bit of a snag there in the Senate. I think it's what happens when you don't have kind of four corners agreement going in, or when you introduce the bill itself. But to be honest, Chairman Smith has been working very hard to get Senate GOP members, especially, on board. I agree that the outlook's not looking good for it, but I wouldn't nail in the last nail just yet. Last night, Leader Schumer basically put the bill on the Senate calendar. Obviously, that does not mean there's going to be a vote necessarily, but I think some of the expectation, at least among some corners in the Senate, is that there is the goal here possibly would be to allow for the next 2 weeks of recess to kind of give a last ditch negotiating time here. And then possibly, depending on how that goes, have some action the week of April 8th. Granted, this is probably a best case scenario for the prospects of the bill. But it's not going to go down without a fight. And even if no agreement is reached between Chairman Wyden and Ranking Member Crapo, it's possible that Schumer and Wyden decide to move forward and basically dare enough Republicans to vote no. As was mentioned, the TCJA provisions in the bill are extremely popular amongst not just industry but also Republicans in general. So when push comes to shove, it might be a little harder to vote no there on the floor. But we'll see. Ranking Member Crapo has been driving a hard bargain on this one, and obviously he's looking towards 25 when everything else is up. But it's also interesting. You mentioned the retroactive piece, especially for R&D, Mary. And yeah, I think the longer this holds out there, the harder it is to go back all the way and reinstate it. Because if folks are, as you said, kind of surviving and doing okay, then that justification gets harder and harder for Congress.
Yeah, and I mean, Crux doesn't spend a ton of time talking about tax outside of the energy tax space, but right, Alfred, we have had this conversation come up over and over and over with folks who are looking at the outlook for this policy as having a material impact on their tax credit buying strategy. So wanted to kind of kick it over to you for a second, Alfred, and kind of tie it back to what we're seeing in the clean energy tax space, given some of the political developments that David and Mary are talking about.
Yeah, so Katie, I'll answer that question directly, and then we'll make one observation about the proposal. So in the wake of this being something that was navigating its way through Congress, a lot of potential buyers hit pause, just not knowing what the potential implication would be to their tax liability. And so we saw the late 23 market for transferable tax credits be very hot. So we did a market survey where we estimated that 7 to 9 billion of 2023 credits will transact. We showed very strong pricing in that survey. Demand outstripped supply in late 23. And then as this bill found its way through Congress with quite a lot of bipartisan support initially in the House, there was a bit more waiting to see how this would influence tax liabilities. I think there is now more of an emerging view in the direction of what Mary suggested here about the legislative prospects that is leading more potential buyers to come back to the table on the assumption that this probably is not going to be passed in this Congress. And if it is, it wouldn't happen before the election. So that is starting to manifest in what is more realized demand on the buy side of the market. The last sort of political observation I would make here is it is interesting that this bill passed the House with 356 votes and was a deal that was cut between a Republican chair of the Ways and Means Committee and a Democratic chair of the Senate Finance Committee. And it is not, bipartisanship is not the word that is most associated with the 118th Congress, but it is interesting that there has been support for an expansion of tax policy subsidy in certain areas, even in this Congress, notwithstanding the fact that it is unlikely to be passed in the time before now in the election, if we're believing that Mary and David are right on that.
Yeah, thank you. And I mean, I think an obvious next step is also to talk about tax policy in 2025, but I want to detour quickly to the sort of the international, some of the other pressing tax policy issues that companies today are facing. So Itai, I wanted to kick it over to you, speaking kind of about the state of international tax policy. And I think Mary and David, I'm also interested in the politics of this and how that plays out domestically. But Itai, when you think about the formation of the OECD global minimum tax regime and Pillar 2 rules, maybe could you share with the audience just sort of where are these negotiations? What are the implications of some of these processes, especially on the implementation of the IRA?
Right. So, I think it is important to level set, given the role that I had. I think first of all, it is clear, right, that the U.S. did not go forward in the way that the Biden administration had hoped in 2021 with respect to compliance with Pillar 2, and that creates a series of pressures that may or may not mean that the U.S. has incentives to go ahead and do a qualified domestic minimum top-up tax and go to a country-by-country GILTI system in 2026. But I think the important thing to think about for purposes of this call is just like, what's the consequence for the green credits? And there, I think that those issues have largely been resolved and been resolved very, very favorably, right? So, you have guidance that's come out of the OECD in February and July of 2023 that makes it really clear that regardless of whether you're entering the green credit space through a traditional tax equity structure or through the new transferable credit regime without any tax equity interface, the treatment is not to treat the use of the credits as reducing the amount of tax that you pay for purposes of determining your effective tax rate. Rather, the credits are treated like income, which reduces an ETR, it's true to some degree, but by a much smaller amount, right? Like 1/6 as much as it would be if a reduction in covered taxes. And for most buyers in the marketplace, that has provided the certainty that's necessary to be able to go forward, at least not worrying about the Pillar 2 issues, I guess is what I would say. There are obviously lots of other uncertainties in the marketplace, and those all still play out. But I think for the most part, the Pillar 2 issues have been put to bed. You do occasionally hear companies raise the question, well, okay, but what if foreign sovereigns don't do what the OECD has agreed? What if they have a more aggressive version of the undertaxed payment rule? Could I then end up in trouble? And I guess the answer I give to that is look, the people who are going to, if the United States, if anyone is in UTPR, and it could only happen in 2026, after what is probably going to be a U.S. tax bill in 2025, the way that UTPR will be calculated will be led by the Europeans, because you've got the whole EU saying they're going to do it. And they've been incredibly clear. They're doing it exactly the way the OECD guidance described. They have European Commission statements saying that. They have statements of every head of government in the EU saying that. So I think to the extent that people are worried about somehow there being a rule that's more aggressive than what has been agreed, I don't think people should worry about that. That's what I'd say.
That's super helpful. And David, you and I talked about this briefly a little while ago, but when you think about some of the domestic US politics, and again, we're kind of talking about 2025 tax reform without talking about it, but when you think about some of the domestic politics around the OECD minimum tax regime, do you see any prospect for the US to become maybe more engaged and involved with how these policies are implemented or change them materially?
Right. At least from a I think Republican congressional perspective, it's a long uphill climb here. We even saw just this morning, Treasury Secretary Yellen was before the Finance Committee, and Ray Crepo talked about both pillars in his opening comments, and did not exactly have nice things to say. We saw it last week. Last week over in Ways and Means was more Pillar 1 focused, but it kind of the same kind of reaction there. What it's going to take to get a congressional Republican to the right spot to either implement Pillar 2 in domestic law, or B, Pillar 1 through a treaty in the Senate. I think it's got a long way to go. I think some of that might be if international countries move forward. There might be a forcing mechanism, but at the same time, it seems like as every day goes by, congressional Republicans get a little more and more dug in on both these issues.
Yeah, if I could just add, I mean, I think the politics here are a real challenge. I think there was frustration on the Hill, probably on both sides of the aisle, with the Biden administration, the way they move forward and the communication. I get the sense that may have improved a bit from last year, but you're seeing things like the House Republicans introduced a bill back in May that was retaliatory, right, against countries that adopted certain aspects of Pillar 2 in the OECD process. So the idea that there'll be a congressional, a path to implementing this that would require legislation is, I think, I agree with David. It's hard to see, and I don't know. This is not my practice area, so I'm not a specialist in international tax by any stretch. But my advice to the OECD would be, think again if you could make GILTI Pillar 2 compliant. That may be a good path that would get it over the finish line.
I mean, I think I just want to say one thing about the reality here in connection with the green credit market without sort of addressing any of the rest of it, which is just to say, look, I mean, the bigger picture of the 2025 tax debate is there are a huge number of individual tax cuts that are supposed to expire. The revenue number that you need to extend those cuts comes into the trillions. As a result, many people, and it's without regard to politics, think that there will have to be some revenue raisers. That means lots of folks, for good or bad, think there's a real chance the corporate rate goes up. To the extent that the corporate rate goes up, even fewer taxpayers can even possibly be in the UTPR. And so the reason I bring that back here is because we're focused on the green credits. And I just think that all of this stuff about whether or not the US comes into compliance on Pillar 2 just doesn't affect the green credit marketplace. There are lots of other issues out there. There's all kinds of, I could say all sorts of things. In reaction to Mary and David's comments, not really wanting to go to any of that, but just to say, for the green credit space, it doesn't matter.
Yeah, no, I mean, that's super helpful, Itai, because it is beyond kind of where we even can go with the time available. And I think even the point that you were making earlier, which is that, and how the green credits are treated under Pillar 2 is not necessarily, doesn't get as much attention probably as it should. So I think it's super valuable to flag that. Again, it's kind of, everything goes back to 2025, which is somewhat inevitable. But before we get into that part of the conversation, again, I also would like to go to you, Jonathan, and just talk about where we are with Basel III, the energy industry, which does not normally think about necessarily Basel III, got kind of a crash course in Basel III regulations when the draft rules came out in July of last year. So I was wondering if you could give kind of a brief background on sort of how that rulemaking came to be, and in particular what the energy industry is really primarily focused on, which is the 400% proposed risk weighting on tax equity investments.
Yes, absolutely, and thank you very much for including me. So basically, the Basel Committee on Banking Supervision, or Basel, is the global standard-setting body for bank capital requirements. Banks have to meet capital thresholds based on total assets as well as based on risk-weighted assets. It's kind of hard to overstate how important to banks the regulatory capital requirements are for them. You can kind of think of bank capital requirements as setting the relative and absolute costs of bank exposures and activities, and that in turn then drives bank behavior accordingly. And so risk weighting of assets is one mechanism that the bank regulators use to accomplish that. So Basel itself has been issuing updates frankly, of increasing complexity to its regulatory capital framework since 1988. The most recent update, which is known collectively as Basel III, that began after the 2008 financial crisis, and somewhat confusingly was issued in parts rather than just one big package. And the last part of the Basel III package was issued by Basel in 2017. But just because the folks in Basel say whatever, that doesn't make it so. National regulators all over the world have to then actually implement the Basel framework. And frankly, US and other regulators implement the Basel frameworks more often kind of in the breach than the observance. So in the US, the Office of the Comptroller of the Currency, the Federal Reserve Board, and the FDIC are responsible for implementing this final part of Basel III, which is why it's called the Basel III Endgame, because it's the last piece of the package. So the US regulators proposed this package last summer. It's a huge package. It translates into 300 pages in the Federal Register. If you've looked at the Federal Register, it's at like really small print in 3 columns. That's 1,000 pages in kind of normal writing. And in that huge package, the US did a lot more than just kind of implement the final piece of Basel III. It also included a lot of, I would say, kind of more aspirational and opportunistic components following the last March bank failures. And that, as a result of all that and the complexity of it, it's been met with kind of unprecedented levels of skepticism across the political and policy spectrums. And among the many things in there, as you note, is altering risk weights assigned to certain exposures, specifically quadrupling the risk weight for non-publicly traded equity exposures, which is the issue that is causing problems, I think, for some of your funds.
Yeah, thank you. I mean, it's so complicated, but Alfred, I think this is something we've run into quite a bit again, which is, maybe you can touch on how, from our perspective, the market has been relating to concerns around Basel III and the endgame requirements. Just obviously this is a policy that affects large banks. So from our perspective, what have you seen on how this is affecting the behavior from large financial institutions?
Yeah, so when the rules came out, or the notice of proposed rulemaking last summer, there was just a ton of attention from the industry on it. We saw a lot of comment letters, a lot of engagement because of the perceived treatment of tax equity that would be punitive. I think in more recent months, we've seen statements from Jerome Powell and testimony and in other places that have given the industry the perception that this is trending at least to a liminal place, like trending to a place where nothing is going to get executed immediately and is probably going to be improved substantially in the industry's view versus the notice of proposed rulemaking. And so I think that has led to somewhat more engagement by the banks here versus the initial response that this may be very punitive to tax equity and that they would slow investments and participation in tax equity structures. We did see some large banks pull back on that belief in the fall and even into the early part of this year. I think now we are seeing a little bit more further engagement, and one way in which that is intersecting with the transferability market is banks are increasingly writing into their partnership agreements around tax equity transactions the ability to transfer credits out of those partnerships. And the thing that they are doing there, of course, is allowing for the fair market value to be established by transaction into the partnership, monetizing depreciation, and then giving additional space to sell the credits out of the partnership. And that's a strategy that they had been somewhat more hesitant to do when there was a perception that tax equity would be punished with the 400% risk weight, or assigned the 400% risk weight. So I think that the market here is becoming a little bit more active around tax equity, and people are doing more novel structures around tax equity as we await further regulatory guidance here that is likely to take longer than was initially envisioned.
And just maybe to add one thing to that, I mean, obviously this is just the tax equity piece is just one, in the grand scheme of Basel III Endgame, relatively minor provision in this massive package. And so its fate is largely tied to this overall package. And as Alfred mentioned, I mean, I think this is an easy fix here. There, industry comment letters across the board have suggested any number of solutions that the banking agents could use to fix this. The issue is just that it's tied up in this massive piece of rulemaking, which industry is threatening to sue over. They might have to go back and repropose. So there's a lot of uncertainty around timing. But again, it seems to me that there are plenty of solutions to fix this if they want to. It's a bit of a kind of an unforced, frankly, policy and political error in the first place. But its fate is largely now tied to all these other things.
Yeah, and I mean, I think the scope of the regulation being so massive, right, Jonathan, it just really makes it challenging. Is there anything from your perspective that makes the timing of the regulation more challenging, sort of given the political backdrop? Is there any more urgency or less urgency? Is there anything from that perspective that folks should be thinking about heading into the end of this year?
Yeah, well, I mean, just generally, this is not specific to just this one rulemaking, but there's a lot of, urgency to get rulemakings out, just, pending, November election and pending, the congressional review look back period. So there's just generally a lot of emphasis on getting things done, including this major package. There's basically no chance this gets done though in the near term, just because of its size, the threat of litigation, the possible need to repropose, the desire that the Fed Chairman Jay Powell has expressed of having broad support for whatever comes out at the end of the day. The Fed's also stated commitment to Congress and others that it will put out first a quantitative impact study before it, ultimately finalizes a rulemaking. All that takes an incredible amount of time, and so the ability to actually get this thing finalized, even by then this year, I think would take a lot of doing, and that assumes no one's going to challenge it. So that assumes that the outcome is the way industry likes it, which is at this point unclear what will happen.
I do think as a practical matter, the timing of the notice of proposed rulemaking last summer intersected interestingly with the development of the transferability market, right? We saw the first deals via direct transfer start to close in August, or start to be announced in August. And I think the implication of that is banks were looking at the potential regulatory capital risk associated with tax equity at the same time that the transferability market was starting to accelerate. And the kind of behavior that we saw in that period was many banks decided that, or wanted to at least test the transferability market in order to make sure that there was an additional way to offload credits if they needed to, or find another business in replacement of tax equity, either for syndication or for meeting their own need from an effective tax rate management perspective. And I think that probably on the margin accelerated the development of the market via banks in the back half of last year. And, we picked up more transactions than was anticipated, some large ones direct to banks. That Bank of America Invenergy transaction was one of the first ones announced in the market. And I think it is probably not a coincidence that those two things were happening around the same time.
Yeah, and I mean, one of the points you made, Jonathan, which is I think broader even than Basel III, is the idea that the Congressional Review Act figures into the timing of the release of regulation. And Alfred and Itai, I know we discussed that dynamic both, together and separately, in terms of the Congressional Review Act placing some sort of timing pressure on the release of regulatory guidance related to transferability and other green tax credits. I wanted to see, I mean, outside of Washington, people may or may not be very familiar with the Congressional Review Act. But I wanted to see if either Alfred or Itai, if one of you wanted to spend just a moment kind of refreshing on that topic and what folks ought to be expecting in the next few months related to Treasury guidance.
Itai, do you want to start and I'll layer in?
Sure. I mean, so the Congressional Review Act allows Congress to review major rules issued by federal agencies before the rules take effect. And it also gives Congress the opportunity to disapprove those rules, resulting in the rules having no force and effect. That's the thing about the Congressional Review Act. Now, the thing is that Congress has a limited period of time in order to engage in the Congressional Review Act process. And basically, there's a rule about how many session days, days of continuous session have to pass. Congress has to act before that number of days, and so it's sort of like an art more than a science to figure out what deadline that puts on the U.S. Treasury to get guidance out under the IRA if they want no risk, 000 risk of Congressional Review Act review in the following Congress, which is, I think, what they would be worried about. They would be worried not so much about this Congress where, there's, split control between the Senate and the House and things are a little dysfunctional and not much is getting done. The fear is, well, but what happens in the next Congress? We don't know who's going to control. And the answer is, sometime in April, if you want no risk of Congressional Review Act, you've got to finalize rules. And so I think there is at least a reason to have hope that on this body of guidance, we're likely to see, final rules under things like 6418 in the next month or so. I think there are pressures on the Treasury to suggest that that's something they'd want to do.
I agree with that. Also, we saw elective pay final rules earlier this month. Previously, elective pay and transferability rules, proposed rules, were announced at the same time, and around the time that they announced those elective pay rules, and in the press release said that transferability guidance was coming soon, which I think all corresponds to Itai's timing there of sometime in the next month. The market is broadly anticipating that.
Yeah, well, and I think this is a great question to kind of tie into going into 2025. So someone asked, avoiding the CRA for Section 48, for instance, which was proposed, contours of which were proposed last year, seems reasonable. But thinking about Section 48, Cap E, so the technology neutral ITC, which has not necessarily been laid out yet by Treasury. It doesn't go into effect until after the end of, I believe, next year. So kind of thinking about one of those tech neutral and even, the Section 45 tech neutral tax credits, what are some of the potential risks or timelines that we want to think about related to the implementation of those new tech neutral tax credits? And I'll just kind of lay out that I think, Itai, to your point, if you want to avoid the CRA, final in April would imply draft several months ago, not tomorrow.
Right. Like that. Yeah, I think my point goes only to things that have already been proposed. That's correct.
Well, so let's kind of talk about, I think, 2025, because we've got, we're trying to be mindful of time and we've got a few minutes left. So heading into 2025, we've got the expiration, as a lot of folks have mentioned, of some very important tax credits, particularly on the individual side of the code. So how should we be thinking about, the balance of tax policy through the end of this year? Are we likely to see, major new tax policy items introduced? I would love to just maybe go around and hear from folks a couple of thoughts around how to think about the rest of this year.
I guess I could start. So, putting that aside, the tax package that we talked about at the beginning, I think it's going to be a really quiet year. We'll see, President Biden introduced some of his new tax proposals at the State of the Union, and then his budget came out at the beginning of last week, which had a lot of carryover items, but a few new items. So it's sort of his line in the sand, and we'll see where candidate Trump goes if he makes tax a major issue or not. It's kind of not clear to me, given that we had the Tax Cuts and Jobs Act, and maybe it's just more about extending things is the Republican position. But I think we know what the law is in 2024, so that's really great. You know, we can plan. And, you know, maybe you want to think about, okay, what if something happens in the future? Is there something I want to do this year? Because I think it's going to be quiet in terms of actual legislation.
Yeah, I would also tend to agree that I think absent the current tax bill, I think, yeah, it's gonna be pretty quiet in the tax front through the end of the year. 2025 is the Super Bowl, the next Super Bowl, when it comes to tax policy. And the expiration of all those individual provisions from TCJA is definitely an action forcing mechanism, no matter how the elections go. Because there's no way members of Congress can let all those individual provisions expire. Maybe some of them, but definitely not all of them. So no matter what happens, there's going to be something then. We're already seeing it with Republicans on House Ways and Means. They are putting together, we'll call them working groups to kind of grab their heads around some of the policies of TCJA, what they want to keep, what they want to change, maybe new policies. Because if you look at Capitol Hill, and I mean the House especially, there was a lot of the members who were there in 2017 are no longer there. If you look at Ways and Means, it's just a very small handful of the committee members who were there in 2017. Look at the staff side, it's even less. So it's going to be, I think the next year will be spent a lot in the kind of education and preparing kind of space to get ready for that negotiation in 25.
Let me just pick up on a couple things that David and Mary said. I mean, first of all, I totally agree with David's point, which is a polite way of saying it's a very different Republican Party than the one we had for the 2017 Act, and that is a consequential point. It is a deep and consequential point. The second thing is, I felt myself laughing at Mary saying it's great that we know what the law is in 2024. I completely agree with Mary, but God, that's where we are. We have to get to the end of March of 2024. A well-run country should not have that situation. Let's all be clear about it. We should be we have clarity for 2025 in March of 2024. That would be a nice sentence, right? Obviously, Mary can't make that happen. But I sort of agree with what everyone said before. I mean, the one thing I would say that's to go a little further is look, none of us know what the election will bring, and the outcome of the election has huge consequences for what David called the Super Bowl. But one thing I think you can reasonably assume, or at least it should be your base case, is that we will have split government. We are not that likely to have all Democratic or all Republican control, okay? Which means there will be some, that is actually a low political probability, I'm willing to say it, right? Your greater than 50% should be, we're going to have split control. So if that's the case, there are going to be compromises over all kinds of stuff, and there's a lot of individual tax cuts that members on both sides of the aisle will not want to have expire, and there will be questions about how to fund that. And everyone should just be realistic about that. That's all I got to say.
Actually, Itai, to follow up on that point, the pay for side is going to be, I think, a much larger piece of this conversation than it was in 2017. I mean, look at the way that the deficit situation is much different. And as you said, the Republican Party is much different as well. So when it comes to paying for certain other tax provisions, I think that's going to be a much higher priority this time around than in previous years. So what that looks like, I think, is still a little TBD, but something we should all be thinking about. That's for sure.
One other legislative observation that I would make sort of historically is think about the way that we are looking at the TCJA in 2025 and the observation that the fact that it is repealed is driving, or that it expires is driving the conversation. In most cases with tax policy, there's an expiration that drives a conversation, and it is less likely or less common that you see a repeal of something that is current law. And one thing that the IRA tax credits have going for them, and the IRA in general, is that the credits are provided until 2032, or in some cases longer. And that's a benefit versus others that may be expiring over the same period.
Yeah, and then, you know, you always hear this question, well, but what about like the political debate about the credits? And I think, you know, just on this call, I would say, I mean, you see so much investment being driven by the green credits into red states and red districts that it's really important to keep that in mind in terms of where members' heads will be. You also see more and more vitriol about the credits that are available to individuals in the EV space. And both of those things are happening. And I think that's just the honest truth about what's happening with respect to the IRA provisions. The corporate credits are much less controversial than the individual ones.
Well, with that, I want to again thank everyone for their time, and everyone who joined us today. Appreciate taking 45 minutes out of your day to talk about tax, which may or may not be how you hope to spend your afternoon. So, but we're very thankful for it. We appreciate the time of all of our really brilliant panelists and the breadth and scope of the discussion that we had. So I want to thank you everyone again. And look forward to hearing your comments and questions. The recording of the webinar will be posted on our YouTube page probably later this evening or before the end of this week. And I just want to say thank you again.
Thanks,
Thank you.
everybody. Thanks for joining.
Appreciate it, y'all.